Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. Overnight, most of the markets experienced a significant downturn, often described as a washout, largely contributed to a spike in US inflation data. This development has dampened expectations for the US Federal Reserve to initiate interest rate reductions as early as June. In March, the Consumer Price Index, or the CPI, showed an increase of 0.4% from February and a 3.5% increase from the previous year, slightly surpassing expectations. Core prices rose also more than expected, excluding volatile food and energy categories. Following the data release, markets have now adjusted their expectations with fewer bets on the Federal Reserve cutting rates multiple times this year. At the beginning of 2023, forecasts hinted at least 6 or more rate cuts through 2024. However, minutes from the Fed's March meeting suggested concerns about stalling progress towards inflation target, which is at 2%, possibly requiring a longer period of restrictive monetary policy. Investors now turn their attention to this Thursday's PPI number, or the Producer Price Index, which could support Wednesday's CPI data. So looking at the technicals, and the market plummeted through the 60-day moving average, now turns towards its key level, which is seen at 64.8090. Monitor from there, as a break would give further concerns to the bullish case up to 66.67 cents, which still holds. Nevertheless, a break here would initiate stop losses and see a move down to around 63 to about 62.5 cents. With all eyes on the ECB, the market is widely expecting the central bank to keep its interest rates on hold at 4.5%. Keep an eye on the statement note, which could give us a little bit more to a dovish tone. With the market pulling back very aggressively as the dollar index, which measures the greenback strength against a basket of 6 major currencies, trades around 105.20, all eyes look towards this key level, which is at 107.1025. While intact, the upside call to 109.110 still remains, but like the Australian dollar, taking out 107.10 could see stop losses triggering down to a move of 105.80. Dollar yen clears the 152, or more to the point, the highs last seen in 1990, and posts an intraday high around 153.20, and with no intervention, as many have thought, from the Bank of Japan. Nevertheless, the break of 152 now leaves me neutral, and therefore await better opportunities for the market to come back into play to trade, and keep an eye on this level, seen around the support level of 152.4060. As a break there could initiate a move down to 150.5, which is the next key point. Sterling also whipsawed and plummets lower towards this key level of 124.80. As long as this level holds, I'm still calling to the upside of 127 to 128. But like the Australian dollar and the euro, a break of 124.80 would see significant stops and see a move down towards the region of 123.70. We finally got a pullback in gold after it recently hit the highs somewhere around 2,355, and from there the market is showing a somewhat mixed bias due to the divergence coming to the bear case. Could see a little bit more to the weaker side, which may see an unwind in prices towards 2,300 as initial target. Viewing the upside, the resistance comes in at 2,353 to 55. Wrapping up with oil, the market's still a little bit mixed and still finding support around this level of $83 a barrel. Overall though, with the technical still remaining somewhat buckled, I'm not abandoning my view as of yet to 83.70, or where the support may hold underneath at 81.7090. Well, that's a wrap. Thank you for joining me, and as always, look out for the intraday report. I hope you enjoy the great start to the day.